In the last week, we have witnessed two of the largest bank failures in the history of the United States, with Silicon Valley Bank and Signature Bank. However, what makes this so much worse is that we're not necessarily out of the woods, and there could be more around the corner.
The FDIC just reported the California regulator shut down Silicon Valley Bank.
This is the biggest bank failure since 2008.
Well, Silicon Valley Bank Financial Group has filed for Chapter 11 bankruptcy protection.
They just came out and told us that the bank is shut down.
So let's talk about exactly what's happening, is your money safe, and what you can do to make sure this doesn't happen to you. Although before we start, if you like this sort of content, make sure you subscribe to the channel. It will really help us out. And don't forget to ring the bell so you get reminded every time we drop a new video. Okay, so let's talk about what started this whole thing. Silicon Valley Bank is the 16th largest bank in the United States. They've been around since 1983, and they were based, as you may guess, in Silicon Valley. But as their name implies, their focus was around tech and the startups and the venture capital firms that funded those startups. The bank claimed at the end of 2022 that nearly half of all U.S. venture-backed startups use their services. And for most of the last 40 years, that niche has worked really well for them. But here's where you want to pay close attention, because it all went to hell pretty quickly. By 2020, when interest rates were down to zero and both banks and people were flush with cash, and almost all that cash found its way back into the financial systems. Now, ordinarily, that would be a really good thing, and it was for a while. Banks typically keep what they call reserves on hand. All that means is that for every dollar you put in the bank is going to keep a certain percentage in reserves in case you suddenly need your money back. They use the rest of that money for loans and investments, which of course is how banks grow. But let's look at it this way. If I'm your bank and you deposit $1,000 with me, I will typically put aside some money in reserves. Let's say the amount is 10%. That means I keep $100 in the bank and I can use the remaining $900. Now, I may use that $900 to loan out to people to buy cars or homes or invest in a business. Okay, that sounds quite simple enough. But what if you want to withdraw $200? Well, the bank is assuming that if enough people deposit enough money, then at any given time, they will have enough money in reserves to pay you out when you want to cash out. There's nothing wrong with that plan, and for the most part, it works really well. However, that 10% that I gave an example was the requirement. In March of 2020, the Fed lowered the reserve requirement to zero, which means banks are not required to keep any money in reserve. That is a problem waiting to happen. But now, most banks are going to keep something on hand. They know that these sort of things happen. They're going to keep that money. They do not loan it all out either. They want to keep some of that money risk-free, if you will, because a loan is by its nature risky, right? What if that person doesn't pay it back? So they're going to put some of that money somewhere where they can get a safe return on their money. And this is the second point I want you to pay attention to. One of the safest places anyone can park money is in U.S. Treasuries. They produce a very modest return, but they are 100% backed by the full faith and credit of the U.S. government. The U.S. would have to completely default, and that is not likely to happen. So this is exactly what SVB did. In 2021 and 2022, they invested nearly $100 billion in government-backed treasuries. And they locked that money up from 4 to 6 years and was paying back an interest rate of 1.79. Now, I know that's a lot of different numbers, but remember, they basically put their money and they locked it up for a few years, and they were earning a little less than 2%. It's not bad, and again, 100% safe. At that point, Silicon Valley made a gamble that a lot of banks make. They assumed the interest rates were not going to rise very fast, and so that their locked up funds earning 1.79 would be attractive over the next few years. That turned out to be a very bad gamble, and it put them in a very bad position if they also experienced excessive withdrawals, which they did. Okay, so hang with me here just a little bit as we do a little Schoolhouse Rock money math. Bonds are essentially a loan. You buy them based on their yield. Meaning if you buy a bond for $1,000, you have loaned someone, in this case the government, $1,000 for a certain period of time. And they agree to pay you back in full when it matures. And in the meantime, you will earn some level of interest called a coupon rate. In this case, SVB was getting about 2%. So let's say the bond was for 5 years. That means every year your $1,000 bond at 2% will pay you $20. At the end of the 5 years, you get your $1,000 back along with the interest that's accumulated, so now you have $1,100. Again, it's very simple, right? But what happens if you buy a 5-year bond paying 2% and say the very next day rates went to 5%? Now, I'm using that as an example to kind of illustrate my point. But let's again, you bought it for $1,000, it pays 2%, but the very next day they came out with a new 5-year bond that paid 5%. What do you think happens to the value of your bond? It goes down. Let me explain. If I have $1,000 to invest, I can either buy your 5-year bond paying 2%, or I can buy this shiny new 5-year bond paying 5%. Why would I want to buy yours? Well, the point is I wouldn't. The only way I might want to buy yours is if you sold it to me for less than it's worth. Okay, so remember that. Remember, the bond is still going to pay $1,000 at the end of the 5 years. So to entice me to buy your bond over the shiny new one, you're going to have to take a discount on yours, which means you're going to take a loss. Now, there's some fancy math that I can do on my fancy calculator that tells me what a good price is, but I'm not going to bore you with all of that. Just realize that as the interest rates go up, the value of the bonds go down. And these two things, excessive withdrawals and a dropping bond prices, are what led to the dramatic failure of SVB. When the tech industry started to have troubles, they needed cash. And where did they go to get that cash? Well, just like you and I do, they went down to the bank and they took out some cash. But unlike you and I that might go down and take out a couple $100, the tech industry took out billions. In fact, according to Fortune magazine, $42 billion was withdrawn from SVB in a single day. Think about that. $42 billion in one day. That forced SVB to sell some of its bonds. But remember, interest rates are higher now. So nobody's going to pay them full price for their lower interest bonds. They had to sell them at a loss to cover the withdrawals. Now, how much of a loss, you might ask? About $1.5 billion. They lost $1.5 billion. All this happened on March 8th. Okay? So a bank can't just take a $1.5 billion loss and nobody notice, especially a bank that deals with a pretty small community. So by March 9th, everybody knew what was going on and people freaked out. Customers had lost confidence that the bank could remain solvent, and they started to take even more money out. And that started what is known as a run on the bank. If you've ever watched the Christmas classic It's a Wonderful Life, the same exact thing happens. The Bailey Building and Loan loses some money and people pile up in the lobby to get their money out of the bank. But the bank doesn't have it all for the same reasons I gave you earlier. They even say as much in the film.
The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house and Mrs. Maitland's house and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
It nearly wipes them out. But that was fiction, and it took place in the 1930s. This is reality, and it took place in 2023. So by March 10th, the bank was on the ropes. Its stock had dropped 60% in a single day, which means nobody was going to loan them any money to get caught up, right? Customers were pulling money out, and the bank was forced to admit they had no other option but to sell the bank. But nobody was buying, and that very same day, regulators stepped in and shut everything down. 40 years of this company, and it was gone like that. So now you're asking, what about the FDIC? Isn't that supposed to help out? Well, yes, you are right. The FDIC will step in and pay up to $250,000 per institution. Now, that sort of thing is exactly why the FDIC was created back almost 100 years ago. It helps us all trust the banking system and trust that when we need our money will be there. But SVB is not a normal Main Street bank that you and I go to. Most of its customers were not small family accounts. In fact, Genevieve from Grit Capital points out that only 2.7 of Silicon Valley Bank's deposits were less than the $250,000, meaning that over 97% of their money is not FDIC insured. Now, for example, I have a Roku TV, so this caught my eye. Roku had nearly $500 million sitting at SVB. For the FDIC to cover only $250,000 doesn't really do them any good. And the FDIC is not obligated to cover anything more than the $250,000 out of their $500 million in deposits. So sometimes when this happens, a bigger bank will step in to acquire the company because they want their customers. But if that doesn't happen, the bank is sold off for parts like an old junk car, and the customers may get some of their money back, but that can take years, and that is almost guaranteed to not be 100% of their money. All of this is bad. It's not even necessarily the worst outcome. As mentioned, Silicon Valley Bank customers were largely tech companies, not you and me. So if these companies lose all their deposits, they start to fold. That means unpaid suppliers, laid off employees, disrupted services, and so on and so on. So the fallout could have been quite severe. As I mentioned, your money is FDIC insured up to $250,000. Above that amount, you are not covered. So these companies with millions in the bank theoretically should have lost millions. But the government stepped in and said they'll cover all the deposits at SVB. That stops the bleeding, and it helps to keep what they refer to as contagion at bay. Contagion is like it sounds. If you catch a cold, you are contagious and can spread that cold. If the market catches a cold, such as the fear that drove the run on the bank, it's possible that you and I also catch that same fear. And we go to our local bank and want to pull our money out. If enough people do this, we could see bank after bank after bank fall just like dominoes. But by the government stepping in to say nobody is losing any money, it makes us all feel a bit more comfortable. Now, as I said, this is a good and bad thing. It's good for all the reasons I just stated. But there are some bad downsides, if you will. Namely, what happens to the next bank and the next bank and the next one after that? Do we essentially ignore FDIC limits, which could lead to riskier behavior? I mean, how would you act if you went to Vegas and you knew that no matter what you did, your losses were covered? Would you act differently? I bet you would. So SVB was a big bank with big important people as customers, right? So they probably got a lot more attention. But what happens to the retiree in Smallville, USA that's been saving all their lives? Will the FDIC come in and cover all the losses if the Bank of Smallville goes under? How much will the FDIC even have available to cover all these banks if there becomes sort of a domino effect? So all of this is leading to one big question. Can this happen to your bank? And the answer is yes, but it's not likely. And there's a few key differences. Silicon Valley Bank had a much smaller base of customers than, say, Bank of America. Their customers tended to have a much larger deposits than the average bank, and their customer cash needs were greater in terms of overall volume than your bank. To give you a comparison, SVB had about 9,500 customers. Bank of America has 68 million customers. A far greater number of people have to panic and cause the same run. Not to mention that Bank of America has way more assets than SVB ever did. So what can you do? Number one, never keep more than $250,000 in cash. That's like checking and savings. Now, for most of us, that's not a problem, but if you do have $250,000, it's likely not all in cash. It's generally going to be invested in something. So it's not just sitting there. Meaning I have money in several banks, and I also have money in brokerage, and that money is invested, so it's not all sitting in cash. And believe it or not, the money you have invested at a brokerage and something like a money market is safer in many ways than it would be in the bank. It's not available to be spent like it is at a bank. Now, again, I am not saying that investing is risk-free. Do not misunderstand me. However, there are some places you can put your excess cash that are better bets than the bank. But let's say you do have a savings account and you've accumulated more than $250,000. It might be time to rethink that. A simple way to spread that risk around is to move some of that excess to another bank. The FDIC cap at $250,000 is per bank. So let's say you had $300,000 at Smallville Bank. Well, you could split it up. You could keep 150 at Smallville and another 150,000 at Metropolis Bank. And now both accounts are covered under that $250,000 cap. I hope that makes sense. The bottom line is you want to be aware of how your money is protected and have a plan if things start to go wrong. Now, if you follow my channel, you know that I often talk about looking at other places around the globe where your dollars will go a lot further. And some of these places have saving requirements, such as Thailand, where you have to put 800,000 baht in a bank there. Or Mexico, where you have to show that you have around $52,000 in some sort of savings account. That can be here in the USA. If moving abroad is something you are interested in, then watching your money and keeping an eye on your bank is something you want to take very seriously. If you'd like to learn more about some of the best places you can live around the world, why not check out our list of top 10 countries for American expats? It's right there. If you'd like to learn more about the cost of living in various countries, check out the playlist right here. I think you'll get a lot out of it. So again, thanks for watching, and until we talk again, keep on trekking.